Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. I have been working in the industry from the last 33 years. I have had the privilege to teach at two of the foreign universities, Valparaiso University and North Dakota State University. I have worked into food industry in India for about five years, and rest of the experience is into teaching. So, friends, this is my privilege that I am here with you to talk about innovative debt instruments. This is the series we started a couple of weeks ago. We have covered 5 parts so far. This is the 6th part about innovative debt instruments. So, I am going to begin with yet another innovative debt instrument, which we call as payable when able debt structure. So, payable when able structure is basically a loan structure that offers borrowers the flexibility to pay when they are able, means they have the income, they have a good financial standing by that time, or they are able to pay, right. So, it means this is a structure, a debt structure which actually considers the borrower's income and financial circumstances, not the timeline, not the mandates from the lender. So, here there is no mandate from the lender, but no guideline, no strict time frame by the lender. Rather, here the borrowers has the flexibility to choose, and then so this is how it's a different from the conventional loans. In the conventional loan, for example, if I am taking housing loan, I have to pay X amount on every 10th of the new month, or same way for auto finance, like that we have monthly obligation. But when that same same loan is on payable PWS structure, means payable when able structure, then companies cannot demand that pay us back, whosoever is your lender, right. Then here comes the borrower's flexibility. Borrower will, many students are on such kind of loan where they start paying once they start earning, even after graduation, okay, unless they start earning they won't be liable to start pay the loan, okay. So, how does this payable when able work, like what is the working of PW structure? It's a debt instrument, it's a kind of loan instrument, of course, unique instrument, because there are certain different features than a normal loan. That is why we are discussing them under innovative instruments. So, first of all, the income, that sharing agreement. So, as IS says, income sharing agreements, obligation to pay is deferred or paused, usually if income fails. So, there is a possibility that your income is, for example, corona came, for example, there could be some economic crisis, there could be an earthquake, or there could be some some kind of natural calamity causing your business to shut down or not being able to generate enough money, right. Either of any conditions, your income has fallen down. So, your obligation to pay back the amount whatever it is paused, for certain time, it is deferred, it is delayed. So, income sharing agreement is there as a part of PWS, and then the loans are conditional, the repayment of the loan is conditional. We call them as contingent loan because they are conditional. It means the lender is not sure he or she or the institution whether it will be able to get the money in this year, in this month or not, unlike a normal loan agreement where we know that every X date of the new month the loan gets paid by XYZ borrower, right. But here it is not the case. Another thing is the payment can be deferred. Some agreements may allow even the deferred payment until the borrower can comfortably afford to start paying, right. It means the date of beginning of the payment of the installment, the first installment, even that can be deferred. The best example is student loans, especially the students who have gone to US, who are going to Canada for higher study, Australia or any part of the world. They borrow loan and their first installment may be delayed to be even to start to pay, because they are not, or they didn't get the job after like 2 months, 3 months, 4 months of their graduation or their completion of their education. So it gets, so the payment can be deferred. That's another way or the functioning. So these are the few major features which we discussed about PWAs, payable when able instruments. So now I would be talking about certain advantages or limitations, which means merits and demerits of PWAs. What are the merits for PWAs? So number one, they reduces risk for borrowers. Number two, they supports entrepreneurial activity. Number three, they addresses funding gaps. Number four, increases accessibility. So the first one is, the first advantage of PW, payable when able instrument, or the plan or the structure, is they reduce the risk for borrowers, because had I been a student, I am going to US for studying, or I am going to X country for studying, for example, and I am not sure how the economy would be doing after 2 or 3 or 4 years of my course, how quickly, how easily I will get the job or not, because I took the loan with the thinking that I will get job immediately after my graduation, my masters, my undergrad or grad. But the reality could be different, because 4 years from now, if you are a undergrad student, you may take minimum 4 years or maybe 5 years even. You are not sure how the things would be, so uncertain and unpredictable 5 years from now, 4 years from now. So this reduces your risk. Otherwise you would be at default, your credit rating will go, whatever the security or whatever you have committed for, that would be at stake. So this reduces your risk as a borrower. That's the first benefit. And then it also helps those people who are young entrepreneurs who have startups, because here if you are able to generate revenue or cash flow, you may pay back. Otherwise you can defer it unless you have enough income, right? So this gives entrepreneurs to take up some risk, to work with the focus, without worrying for repayment of the first installment of the loan you have taken. So this also encourages entrepreneurial activities. That's the second advantage. The startup culture can actually be supported by this. And then there are funding gaps. There are certain set of borrowers who are not actually being served by a regular institution or regular plans. So this particular design of the debt instrument PWA, it addresses that gap, it supports that gap and helps those people who are keen to grow, work, have some good idea, have some intentions, have some good plans to study or research or to start a business. They get supported by this idea. And then of course the end result is the accessibility to formal financing or formal funding goes up. So it increases the accessibility of funds to many people. Of course, as I said, everything has to the other side as well. Certain risks are or demerits are, investors' risk is there, complex terms are there, a potential for long repayment periods, and the fourth one is ethical concern with ISAs. So certainly the investor who is giving funds is going to have a high risk, because he institution is not sure when his funds will be get paid, they will be get paid or not, right? Because of that the terms are complex for these instruments. So the terms and conditions are made complex, so that because the investor who is giving funds would really want his money is assured, guaranteed to be paid. His money is safe. So that is why the terms and conditions of such kind of loans or instruments are very harsh, very difficult ones in fact. And there is a possibility that the repayment period will be very long in many cases, because Imagine a student may get into job, but imagine somebody who has just started a business and in 2020 and then corona comes. For 3 years everything is shut down. So the repayment which was supposed to be or planned to be paid within first 5 years would certainly go to 8, 9, 10 years, right? So repayment period goes longer. You as an investor, as a funding agency, you have no guarantee. So it means the companies who have enough liquidity who would be offering such kind of products. Otherwise, it's not that everyone can afford to offer such products, financial products. And then there are certain ethical concerns, people may take misuse of such loans. Both companies may make terms and conditions very complex and difficult, or it can be actually violated both sides. Ethical concerns are from both the sides. Okay, so this was about the payable when able instrument or structures. There are a few more structures or debt instruments which I want to discuss, which are having certain innovation in it. Another type of debt instrument which we call as innovative are innovative perpetual debt instrument. Innovative perpetual debt instrument means IPDIs. So IPDIs are another very famous ones which comes under innovative instruments of debt. So I am going to talk about IPDs now. So what are IPDs? What does you mean by IPDs? What do we mean? So innovative perpetual debt instrument IPDIs are long term non equity instruments that banks issue to raise capital and meet regulatory requirement particularly for additional tier 1 AT capital under Basel III norms. So this slide which you may have seen clearly tells you that this is an instrument, it is a non-equity, means it is a debt instrument, and it is a perpetual debt instrument, means the perpetual means continuity, means it has no redemption period. Perpetual continuous perpetual debts or perpetual instruments means the maturity is not fixed, is not known. They are long term non-equity instruments that banks issue. The most important thing is IPDs are not issued by anyone else than banks only, and that too for a specific purpose. So IPDs are special purpose instruments which are used by banks. For what is the purpose that banks issues IPDs? The purpose is that banks have to maintain a certain amount of capital, which they call as tier 1 capital. So for additional tier 1 AT1, tier 1 capital, which is a mandate for any company, any banking company or banks to keep. So as per the Basel III norms, we all know we have Basel 1, Basel 2, Basel 3. So in the Basel 3 norms, it was mandated that bank need to maintain tier 1 capital of to this extent. To meet up that requirement of additional tier 1 capital requirement, a bank can issue IPDs. It means no one else can issue IPDs, right. So they are non-equity instruments, they are debt instruments, and they are long term, they are perpetual. So there is some flexibility, I will just discuss about them. This is the first thing. So what are the possible examples are perpetual non-cumulative preference shares, perpetual bonds. These are the few examples, right. Include what? The certain perpetual non-cumulative preference shares, means non-cumulative means where the dividend on preference share is not cumulated. So bonds, or that is one of the example. So these instruments have unique features like issuers discretion to miss out the interest payments and a claim, and the claim supremacy above equity, but after other creditors, offering higher yields in exchange for increased risk to investor. So what is so unique about this instrument, innovative perpetual debt instrument IPDs, that these instruments have unique features like the issuer, the bank which is issuing becomes issuers, right. This is the issuers, the bank's discretion, the bank which is issuing the IPDs, they have the discretion to miss out the interest payment. It means these IPDs may not even generate interest income for the investor. And of course, if it is a high risk, high, less assured asset, means there is a high interest involved. And the claims supremacy also, they have the claim supremacy, means after equity they may, above equity, it means after all other loans, the next turn would be for IPDs, not for the equity. So, before equity the preference would be, we have preferential shares, very much like, so they have preferential right over equity. Same way IPDs would have preferential right over equity in case of liquidation, in case of consolidation of a business, right. So, because of these two things, that there is no guarantee of the interest, that it's not that always that feature can be added. So, if that feature is there, then certainly they become expensive, because bank which is also issuing the IPDs with these conditions, with these terms, would need to pay higher returns, higher yields for, and that which means the higher yield for the investors, whosoever is buying IPDs. So, such things would be for a exchange of high interest rate, a higher amount of income for any investor. Then the banks may issue these instruments in Indian rupees and should seek RBI's permission for issuing the same in foreign currency, and the investor will get the interest either at a fixed rate or a floating rate, referred to a market determined rupee interest benchmark rate. So, because I clearly told you this particular instrument is used only by banks to raise additional tier 1 capital, right, AT1. So, the bank which is issuing using IPDs as their instrument to raise AT1, so they can they have the choice to issue them in Indian rupees, or they can also seek RBI's permission only if they want to issue them in foreign currency. Otherwise, the banks need not to have RBI's permission. So, which means RBI permission is required only if a bank decides to issue them in non-Indian rupees, in foreign currency, right. And the investor who is investing, they will get interest either at a fixed rate, say for example 12% per annum or 14%, 16%, or on a floating rate, both are possible. So, that is why this particular instrument is under innovative category, because there is a flexibility about interest, payments, everything. So, here the bank which is issuing the IPD would have the option to pay the interest at a fixed rate, which is known to the investor as the borrowers both, and it can issue at a floating rate, and the floating rate is decided by linking the rate of interest to certain benchmark rates in the market, like for example treasury bills, for example FD rates, right. So, the floating rate could be equivalent or a percentage higher or basis point higher than the market rate. So, all these options, all these flexibilities are possible in the IPDs. And then further, the IPDs, these instruments cannot be issued with a put option. They may be issued with a call option exercisable after 10 years and only after seeking approval from the RBI, subject to the interest lock-in clause, meaning thereby which banks shall not be able to pay interest if the bank's CRRA is not met. So, there are two types of option, one is call option, one is put option. We have discussed this call and put option in the context of debentures, call and puttable debentures or bonds in the past, in the previous session. The same thing comes in force when it comes to IPDs as well, but this right is restricted only for call option, means put option is what? The The put option is means the investor who buys IPDs has the right to put the IPDs which is not here available. It means the option to put the IPDs or to surrender the IPDs and get paid is not there in IPDs. This is an important feature because the banks which are issuing it, they are using it as a permanent additional capital to 81 requirement. So, they cannot give the right to investor to surrender IPDs and get back their money because they are using it as a permanent additional source of ATI, additional funding source. So, but nevertheless banks have the option, they may use, it is not mandatory even for them, they may issue IPDs with call option, means whenever bank wants, bank can actually call IPDs and pay back, but it cannot be before 10 years, right. So, this may be issued with a call option exercisable after 10 years. So, it means that that fund which is being received through IPDs is going to stay with the bank for 10 years for sure, because put option is not there anymore at all in this, only call option is there, but call option cannot be before 10 years. It means this is a long term investment option, and not only that, even if a bank wants to exercise the call option after 10 years, of course that is conditional, that is the bottom line, even then bank cannot straightway go ahead with this plan. They need to seek the approval of Reserve Bank of India, especially in India, only then they can exercise even this call option, right. So, one call option has to be the choice, like may or may not be there, number one. Number two, if it is there, the bank can exercise it, but only after 10 years. And number three, if bank wants to exercise this call option, then only after seeking approval from RBI. Okay. In addition to this clause or this feature, another thing about the working of IPDs is that there could be an option of interest lock-in clause, which means what? Which means the banks shall not be able to, they are not liable to, they have not obligation to pay interest in certain conditions, especially when bank CRAR is not met. If they are not able to met that CRA requirement, because that is a mandatory requirement. So, even then in that case the bank may not pay, bank is not mandated that bank would be paying the interest. So, typically they are debt instruments. So, interest is big payable, is not the, they are not like equity where dividend is payable, or not preferential where dividend is paid. It is a perpetual debt instrument, right. Like we have perpetual preferentials, we have perpetual debt instrument as well, but this may come with a feature that the bank may not pay, is not liable to pay, right. So, and that condition is if, so this is what the RBI has already regulated about it. So, this is the another feature or another characteristic of IPDs. Then these instruments shall not exceed 15% of the total tier 1 capital and not more than 49% of the issue should be in foreign currency. It means if a company, if a bank has to use 100 crores for example, I am just taking an example. So, that out of that 100 crores, so it cannot, like more than 15 crores cannot come, only up to 15 crore, 15% of 100 means 15 crore can come in a total tier 1 capital through these IPDs, right, and not more than 49% of the issue should be in foreign currency. So, if this is 15 crore, so 49% of means less than 7.4 something, because 7.5 of crore would be 50%, so 1% less, right. So, not more than 49% of the issue can be in foreign currency. Of course, the foreign currency option can be exercised only after seeking RBI's approval, that we discussed a minute ago, right. So, here the if the bank has issued IPDs in foreign currency, it cannot be more than 49% of the total issue value. That is another condition by RBI. And in case investment is more than 15%, it shall be required, it shall be regarded as tier 2 capital. So only this can be issued only in tier 1 capital. For if it exceeds tier more than 50% of the total capital, then remaining or anything above 15% becomes tier 2 capital. It is not considered tier 1 capital, only up to, because AT has its own requirement. So only up to 15% is AT1. So rest remaining portion over and above it becomes AT2, right. So the other feature about IPDs is that investment in these instruments by FIIs and NRIs shall be within an overall limit of 49% and 24% of the issue respectively, subject to the investment by each FII not exceeding 10% of the issue and investment by each NRI not exceeding 5% of the issue. So, it is a very simple rule, but I need to explain it to you that the investment in these instruments, in IPDs, by foreign institutional investors FII and non-resident Indians shall be within an overall limit of 49%, which we just discussed in the last slide, that out of the total issue 49% only after seeking approval from the RBI one can issue to the foreign investors. If it is issued, even then it cannot exceed more than 49% investment by them and 24% of the issue respectively. It means FIIs can invest 49% and individuals cannot invest more than 24%. Of course, that is a condition, and then each FII, so one individual FII cannot exceed 10% of the issue. Total is maximum 49%, but any individual cannot go beyond 10%. So it means we have to ensure like no one exceeds or invests more than 49%, and then individuals cannot invest more than 5% of the issue value. So these are the guidelines by the RBI and SEBI. Then the recognizing the income as interest or dividend would also depend on whether the issuer or borrower bank is an Indian bank or a foreign bank, and in case of foreign banks, provision of treaties would apply. So this is the last point I want to discuss, that either the interest, which is the income, right, interest is received, or if there is any dividend part, then the issuer bank or the borrow bank is an Indian bank or foreign bank, that will decide either it will be treated as an interest or a dividend. And when it is any foreign bank is involved, then the provision of that country, we have treaties. So the tax treaties with that particular country will come in force, that will decide that either that income will be treated as interest or dividend. Okay. So this is all about today. I would like to now wind up, friends, and we shall continue this discussion in future. Time to wind up. Thank you very much.